All right, everyone. Thanks very much for joining our webinar today and for being here on time. We'll give it a couple more minutes as we wait for people to come on in. Um, you know what I like to say, grab your coffee, run to the bathroom, grab your lunch, whatever you need to do to get comfortable, and we'll start right around 12:02.
Grab that notepad and take plenty of notes.
Good call. And get those questions ready, right?
That's right. I always say bring two pens in case the first one runs out of ink.
Oh, all right, and that is 12:02, so we'll go ahead and get started. Again, thank you for everyone to be joining us today. We appreciate you taking some time out of your day to be part of this webinar. My name is Matt Moore. I do business development here at Camaplan Self-Directed IRA, and we're going to turn things over to Eddie in just a moment to give his presentation on the divine difference between syndications and funds. Before we do that, though, I'm going to go through our disclosure. As always, these presentations are meant for educational purposes only. Camaplan does not provide any tax or investment advice. So if you are going to be making any tax or investment decisions, please reach out to the uh, necessary professionals, advisors, CPAs, attorneys, etc., and do your due diligence. Also, quick housekeeping issue is we'll have the chat off as always, but the Q&A feature will be on. So please ask your questions there. I will share them with Eddie. We like to keep this as much of a conversation or dialogue as possible. Finally, if you have any questions about the presentation that don't get asked today, or you have questions about self-directed IRAs, please reach out to me. You can reach me at mmore@camaplan.com, or you can reach me directly at my phone number. So, Eddie, I'm going to turn things over to you so you can go through your presentation, please.
Absolutely. All right. I'll start sharing my screen here. Well, thank you guys for joining today. A little bit about me. Author, wrote my first book here a while back and been in this business a little over 21 years. A lot of people ask me what business I'm in. I'm in the help business. We help anybody from learning about, I'm an educator by trade. So I want to educate people on the divine difference between syndications and funds. And after 21 years of doing this, I've found that the number one thing is what you don't know costs you the most. So that's one of the reasons that we actually do these events. We do these webinars is to educate because we want everybody to feel confident around what we actually do and know about these investment vehicles outside stock bonds and mutual funds. So I'll go ahead and jump in. I would love to see in the Q&A, not to blow it up, but I would love to see in the Q&A, how many people here have heard about syndications? And raise a hands or anything that you can do, or how many people have actually heard about real estate funds? These are two things that a lot of people just don't know about is syndications. And I'm going to go in and explain all these things. So I'm Eddie Austin, the founder of J Capital Investments, an extraordinary capital mentorship program. If anybody's ever seen me on social media anywhere, you can see that BEX stands for Be Extraordinary. So who owns apartment buildings? So have you ever driven by a large apartment building and wondered who in the world owns it? And you probably thought, I bet George Clooney or the Kardashians, they're the ones that actually own these buildings. But that's not actually true. Everybody, everyday people, they own these apartment buildings, and they do this mostly through a syndication model or a fund model. And real estate ownership isn't reserved for the rich and famous. It's built through partnership, structure, and strategies. Everyday people own extraordinary assets. Real estate is built on leverage. Banks lend, investors invest, people and operators execute. It's the power of OPM. So, what is a syndication? You're probably wondering, if you've never heard of it, you're probably wondering what in the world is a syndication? A syndication is simply an LLC that is registered with the Security Exchange Commission through Edgar that is allowed to sell shares of its company. These are A shares and B shares. So there are Class A members, which are the investors, and there are Class B members, which are the general partners or the sponsors. So a syndication is when a group of investors pool their money together to buy a large real estate property. One person or one company, the sponsor, finds and manages a deal, while investors, the limited partners, you guys as the investors, provide capital and you earn passive income and profits from the property. And keep in mind, this is one property and it's one business plan. So this is kind of like a timeline. And for anybody that's ever bought a property, they know what a PSA is. It stands for a purchase and sell agreement. Well, there's a timeline here. And we have to identify an asset before we can ever move forward. So, number one, we have to find a property. We have to underwrite it. Like we have to build a business plan. We have to go through all the financials to figure out, is this an opportunity that will, number one, return somebody's capital? Will it actually repay its own debt? Is it a valid investment? That's the first thing a sponsor has to do after finding a deal. Once they move past that, you're submitting an LOI and you're moving to the purchase and sell agreement. And your due diligence timeline is outlined as well, and you fund the deal before the expiration date. Key thing, you fund the deal before the expiration date. And I'll give you a pro tip here. If you've ever bought a property before, especially an investment property, give yourself and write this down. If you've got your pen out and your pen and pad of paper, your two pens and your pad of paper, put two-week extensions on the back of any purchase and sell agreement. The first time a property goes right without needing an extension, I'll probably retire because I don't know what's going to happen next. Something always happens. Like Matt and I was talking before this, there's always something that doesn't go right. And it's just part of it. So I would give you the pro tip to say put 2-week extensions on the back of your purchase and sell agreement. Give yourself good time to close and nobody's in a rush. So this is kind of your syndication timeline. Then, like I said, you got to identify a property. So for syndication, you have to know the property address. You got to know what kind of debt you're going to use. And then you're structuring your LLC. You're registering that LLC. And you're raising capital under what's called Form D with the SEC. And you're going to have an exemption with that. I won't go too in the weeds on that, but this is really exactly what's going to happen. You're going to identify a property, you're going to get your LLC started, you're going to register that LLC with the SEC, and then you're going to submit a Form D so you can legally raise capital. And then hopefully you're reaching out to people like Comma Club or Comma Plan to start working with IRA members to be able to bring investments in. And then you execute with excellence, we hope. So, how many people have seen the structures of a syndication before? I'm sure that anybody that's ever been around them before, they know this. It's probably an 8 pref with a 70/30. What does that mean? So, first thing, every bit of the profits outside of paying the debt, my investors get, and this is not our model, but this is a very common model. They get an 8% preferred return. That's the Class A members. Money goes through them first after all expenses are paid on the property level, or in the investment level. The next thing that happens is the profits get split at the remaining at a 70/30. 70% to the Class A, 30% to the actual general partners. If you're not meeting the 8% preferred return through cash on cash, there should be no split beyond that. It should be incentivized as the investor gets money first, so the general partner is incentivized to perform above an 8% level to actually make this work. So every good deal starts with a solid business plan. Just period on that. You have to have a solid business plan and you have to execute on that. So the legal framework here, private placement memorandum is called a PPM. You're going to have to reach out to an attorney. You're going to have to draw up a private placement memorandum, and you're going to have to draw up an operating agreement and a subscription agreement. And most likely that is encumbered into one document, one long confirmed PDF that's all compiled in the same document. That's kind of your legal framework. An investor is responsible for reviewing the PPM, signing the operating agreement or at least initialing it, and the subscription agreement, which also has kind of your suitability study. If you actually are able to invest, you're going to put in your criteria there.
Eddie, just as you're going through this and you're kind of walking through how these things get set up, could you talk about, t typical timeline to get these created and cost associated with them?
Absolutely. Cost is the big thing. And at the end of the day, there's a lot of legal fees that has to happen, especially when you're starting out with a new property, new offering, you've never done this before. So the timeline can be very long and it can be very stressful. And once your legal documents are ready and investable, it's good of a sponsor to go in and start setting things up with companies like yourself ahead of time so you're not trying to stumble or fumble through that while you're trying to get. Because remember, you have like a 45-day timeline to close this property. So in the due diligence phase, you're probably not sure if you're going to raise capital yet or not. So you might not have your documents. So once you do have your documents and you're legal and investable, you might only have 45 days to raise capital. And like right now, we're raising capital on a $10 million fund. So you're not going to raise $10 million in 45 days, most likely. So you've got to set things up right. And that's one of the reasons we do a fund model. That answer the question there?
It sure did. Thank you.
Perfect. So I'll keep going. So syndication is a single asset. It's one LLC per property. It's multiple investors and one opportunity. And keep in mind, all your eggs are in one basket. If you probably haven't found out by now from the tone of me and the way I'm projecting this, I'm not a huge fan of syndications, and I'm going to tell you why. So the challenge of this is repetition. Repetition. Each new deal, it starts from scratch, and there's high costs, there's high pressure, and there's really high risk to the investors and to the actual sponsor. And here's why. Because they've signed a purchase and sell agreement. They put their earnest money down, it's called EMD. So that money could be at risk of the sponsor actually losing their earnest money to purchase this property. So they start risking themselves by moving too fast, not checking all the boxes, not doing the due diligence. And at the end of the day, they got to raise capital really quick. So they'll put together a pitch deck, they'll put way over leveraged numbers on it, and they'll put it on blast and they'll get it out to everybody. And I've seen a lot of syndicators that will overpromise during this opportunity to raise capital, to get capital in because they've got to get this thing closed. And that is involving a lot of risk to the investor because people are not taking time to check all the boxes correctly. So just full transparency here, guys. If like somebody's really pressuring really hard on getting you to invest in something and you know it's a syndication, ask the right questions. Hey, how much capital are you raising? Is there any risk? What's the underwriting? Like you want to really slow things down because the last thing you want to do is invest in something that they missed a lot of skeletons in the closet.
And I kind of to hear to rephrase or think about what you're saying is not like you're saying, oh, people who do syndications are bad or anything like that, but
No.
rather there are circumstances, mainly the circumstances of time, that kind of create this that increase the risk. Is that right?
Yeah, I mean, at the end of the day, if you're in a syndication and you have a tight closing timeline, it is an environment. And I'm not saying all syndicators are bad by any means. I've certainly syndicated more than I care to talk about. Lots of deals that I've syndicated. But at the end of the day, it is a stressful timeline. And it gives a breed of opportunity for things to be missed. And it's not at fault always of the actual sponsor, the actual deal finder, and the actual person putting it all together. But when you have to move so fast, it really makes things easy to miss. And you can drop the ball and you don't mean to. But guys, here's three things. If you want to write something down, write this down. This is actually, there's four things you cannot get wrong in any deal. I'm going to say real estate because that's probably what we know best. You cannot get these things wrong. Number one, location. If you bought the wrong location of a property, you can't take a helicopter and like pick this thing up and move it. It's just, it's there. It's built there and that's where it stays. So location, location, location is always the most important. So location's number one. You have record on deed, you have your syndication documents tied to this address, like that is the property you're going to buy. You can't change it. So if you pick the wrong location, it's not going to work. And number two, the basis. So this is the price you pay for a property. If you paid too much for the property, then once you close, you sign the dotted line, you can't go back. Like you can't go back to the bank and say, hey, I paid too much. I overpromised my investors it's not going to work out well. They're going to say, sorry, I should have put more money down. Sorry, it's already closed. There's no restructure once a property's closed. Like you're locked in for however long that loan term is and however long your PPM said you're going to hold the property for, probably 3 to 5 years. So there's no going back. And then the number three thing is the terms. Like, let's say that you get through this thing, you pick the right location, you paid the right amount, but yet the bank is a floating rate debt. And you're like, hey, when we signed our documents, the interest rates were this number, and now my first payment's coming out, it's a bigger number. I didn't anticipate for this. Also, if there's any other terms, like there's any other uncovered fees or things that happen that drug down the deal metrics, the returns of the property, and you're like, hey, it's going to make it really tight for me to make my payment. This is an issue. Cable contracts are another big one. You can buy a property that has existing contracts on it that get transferred over to you as the new owner, and you didn't know about it. So you have to look through these terms. The fourth thing, I think the most important thing that has come over the last 5 years is partners. You have to pick the right partners. This is like a marriage, guys. Like once you get into these properties, like you're in an LLC, your general partners, your investors, you're in this thing as a partnership. And if you pick the wrong partners, it can really stress a deal in a hurry. So hopefully you guys took good notes on that. So here's the next level, guys. What if you could raise money once, deploy into many assets, and de-risk the journey? Like, wouldn't that be a lot easier and less stress on the sponsor? I know it is for me because I've done funds now. We're on fund number three, and it's way less stressful than doing syndications. So, what is a real estate fund? A real estate fund is a pooled investment where multiple investors contribute money and managed into one fund. And that buys and operates several assets, several assets. And instead of investing in a single property, investors own shares of an entire portfolio, and returns from the fund is a collective performance. So let's say that we want to go buy 5,000 units of multifamily property. If you're going to do that, you're most likely going to have to form, let's say that these properties are 350 units apiece. You're going to probably have to do 13 to 14 syndications to buy 5,000 units through other people's money and through syndications. How many people believe that you're going to do it 13 times perfectly, especially on your first one? Highly unlikely. Things happen. You learn more. The guy that closes the first deal will tell you that was the hardest thing I've ever done. The next deal gets a little easier. The third deal gets a lot smoother. By fourth and number five, you're doing pretty good. Like you got this thing figured out. And you've got good investors, you got good partners, you've got the good lender. You got it all figured out. So here's what happens in that scenario. If you did a syndication and you got it all wrong on property number one out of that 13 unit or that 13 property portfolio, that property is going to suffer. And if it suffers bad enough to go to the bank because you can't pay the debt, well, guess what? The person, that sponsor, has lost everybody's money. It's over and done. So if we do this in a fund model, just to give you a paint the picture for you, in a fund model, if we get the first one wrong and we're still paying the debt, it might drag down the returns of the other 12 properties, but we're still going to be balanced. Nobody's going to lose their money. Everybody's going to be in a good position. Just the metrics are going to be a little bit lower than they was projected out. So one fund, and you have many investments. Investors buy into the fund, not a single property. Capital is raised once and it's used repeatedly. Any questions on that one?
No questions.
Okay. So there's one other step that you have to do when you're starting a fund over the top of a syndication. A syndication only needs one LLC to operate, and that is a Delaware entity. Most of the time, we have used Tennessee before for syndication, but most always we use Delaware. And then in a fund, we have one more level of sophistication and separation and protection for the investors. We use a Delaware fund entity, and then we use a Wyoming management entity to manage the fund. So we have way better separation, and the separation has more protection for the investors. So here's the fund advantage. As I talked about, a syndication is one asset. A fund owns multiple assets. A syndication is one asset type. You can only do it one asset type. It's whatever you pick, that's what you're investing in. A fund can own multiple asset types, and I'll talk about that in a second. A syndication is one market. A fund can invest in multiple markets. So every successful fund is built with really good disclosure. So as I talked about in real estate, it's location, location, location. When it comes to a fund, it is disclose, disclose, disclose. And the reason for that is you have to build good disclosures in there so everybody knows the risks. And you have to build those disclosures in there so there's no deception. The one thing I would try to ask everybody out here in this game that is raising money is do not ever create deception. If you want to do something with a fund, if you want to do something with a syndication, then put it in the paperwork, clear, easy to explain to your investor. It's easy to read to the investor so they know exactly what they're investing in. I can't tell you how many times I spoke with an investor. I'm like, what's the lockup period? How do you get your money back? I don't know. Well, how's the money split after you paid your pref? I don't know. That's alarming to me, guys, because if there's one thing I want to do well, it's communicate. I want you to know exactly what's happening with your money that we use to partner and how you're going to get your returns and how long the lockup is and what we do with cash once it's actually made.
So knowing that firsthand that you're talking to investors who are not they're not reading everything and that is how it is sometimes. What do you do as a sponsor knowing that some people are not doing as much due diligence as they should, but you appreciate that they should know this information because it's better for the relationship. It's better for both of you. You're not trying to hide anything. You want them to know this. You want them to know what's going on. It's only going to be better for both parties. So knowing that people aren't always reading, are you how are you kind of handling that? Are you trying to find a fit better the best fit in the beginning with investors to make sure they are the kinds of folks you want to work with? Are you doing calls to make sure, hey, you do understand everything? Can you walk through that a little bit?
Yeah, yeah, this is powerful. Thank you for bringing this up. I can't tell you how many times I've asked an investor to pump the brakes. I had a call yesterday with an investor that says, Eddie, I read your website mission statement and your guiding principles. And whatever it is, man, I'm with you. I'm ready to invest. I'm like, hold on. Uh, because at the end of the day, I feel like it is our job as a sponsor to communicate exactly what is happening inside because I never want to leave the opportunity for confusion or assumption. Because when somebody is not getting communicated well, they start assuming. And the other part is the relationship to me is way more important than the transaction. Would it have been just easy to say, yeah, man, here's the investor portal, go sign your documents, invest your money? I've learned from experience not to do that. And here's why. Because let's say it's 3 months before he ever hears from me again. And he invests his money and he was ready to go on that day. He was feeling great. Well, what happens is he starts manifesting things in his mind. I haven't heard from Eddie. I don't know where my money is. And they start bringing up all these things to the surface of the scarcity. Man, I just invested 500 grand with this guy and I haven't heard from him. And it looks like on social media he's traveling the world. I wonder if he's traveling the world on a private jet that I'm paying fuel for. That breeds a lot of animosity it could be mitigated, truthfully. So we're always relationship first. So I can't tell you how many times I've told an investor, look, I want to come meet with you. I want to have coffee with you. The relationship to me is far more important than the transaction. I could care less about the money, to be honest. It's not mine. It's all God's, by the way. So at the end of the day, all I care about is we steward it well. The only way we can steward it well is build a relationship with the investor and know, hey, Matt, why are you investing your money? So I usually am interviewing the actual investor, especially the one that just comes in hot. And they're like, Eddie, I've read the website, dude. Love it. Where's the investor portal? Hold on. Why are you investing this money? Well, I make a lot of money in my business, and ultimately I want to remove my taxes from that. Okay, great. I want to come back to that in a minute. What's the deeper question? Why are you investing this money? Well, I just answered that. No, no. Why are you investing this money? Well, Eddie, I have 4 kids, and I'm actually using I want to invest so I can give them a legacy. So they're going to get all this one day anyway, because it's a family business, but I'm investing it to grow it bigger without my hands on it. So I want to put it in a passive investment. Okay, great. What kind of account or what are you using to invest this money? Um, well, we've got this family LLC thing. I said, you got a trust. Yes, we have a trust. Okay, great. We have a document. That's going to be the document you want to use to make this investment. So just earmark that, write that down as a note. When you go to make this investment, you're going to use this. Let me ask you another question. What type of account are you going to invest with? Well, I'm just going to send you cash. Okay, well, hold on. Look, you said you care about taxes. So if you care about taxes, then why can't we put this money into an IRA? Or why do you have a self-directed? Do you have a Roth? Do you have some type of retirement account that's uninvested or just it's usable? Yeah. You do that? Yes. So what did we uncover during this time? We uncovered the most important thing, the why they want to invest the money. That's most important to me. Number two, if he would have logged in the portal, he'd have probably selected the document for an individual. He would have probably just wired the money in because there's instructions on how to wire the money, and it would have been all cash. He would have completely dinged the actual main reason we're removing taxes above the family legacy, and he would have invested with the wrong type of account. And at the end of the day, if I did not slow him down, then he would have been upset with me, unfortunately, because he calls his CPA and says, hey, Eddie's getting ready to send me a distribution check. Oh, that's earned income. Why didn't you invest through that? And what happens is most of the time they usually come back to the expert, the guy actually selling the investment. Eddie, why didn't you tell me about this? Well, because when you called me, you said you read my website and you're ready to go. I wasn't going to stop you. So I think it's best to put in a guardrail, put in a speed bump. What are speed bumps made for?
Slowing down.
They're for slowing down, but the biggest reason speed bumps are put in are to protect valuable assets that's nearby. That's the reason for a speed bump. Is number one to slow down, but the bigger question, why are we slowing down? Because there's children playing. There's nice houses around. So we're trying to protect these assets that are most valuable. So sometimes the number one thing a sponsor needs to do is put in a speed bump and say, hold on, whoa, let's build the relationship first. So here's what I've learned through this is past disclosure, disclosure, disclosure. Understanding, hey, what do you know what asset types we're actually invested in? Because here's another thing about tax. You have to educate the investor. There's certain investments, especially in private equity, they have no tax advantages. And I've actually been the one guilty of telling an investor, hey man, if the only reason you're wanting to invest is because of tax reasons, this deal does not right for you. It will not solve that problem. Oh, Eddie, thanks, man. I didn't know that. So it's very easy, especially when you're in the short timeline. Take every single thing you can get, just shove it in the account as quick as you can because we got to close. But I think it's good for a sponsor to slow down and say, hey, man, this asset type isn't right for you. Or asset types. This is why I like a fund. We give the ability to give cash flow, depreciation, and appreciation all in one opportunity. I believe that transparency builds trust. I don't know how many people would agree with that, but I can't tell you how much more a potential investor appreciated me slowing them down because we built trust because of this transparency that I shared with that person. I've even had an investor that put depreciation in the back seat, the tax advantage part, simply because I was so well at communicating that this isn't the right thing for you. And they're like, no, Eddie, I like it. I the taxes will figure it out. So creating a good fund, number one, starts with an easy to read business plan. That's what a PPM should be is a business plan. And honestly, pro tip here, if you're a sponsor or if you're an investor, um, you'll appreciate a third to fifth grade level PPM that's easy to read. That, and I don't mean that to be offensive. I don't. I know lots of big words. I read on average 40 to 50 books a year. My vocabulary from that has expanded quite a bit. I'm in this business. I've been in this business 21 years. I speak at a different frequency and I don't mean to, but it's just the things I'm surrounded around. So I think it's really, really good of a person building a business plan to slow it down and make it easy to read to every single person so you know and understand it. If we're using great big words like depreciation and cost segregation and bonus depreciation, not everybody understands what that means. So break it down. So, what does a fund invest in and how long does it invest? These are things that should be inside the PPM. What asset types does it invest in? It should be clearly outlined. A solid market study. What markets are we investing in? The fund has the ability to invest in Florida, Georgia, Texas, any one that you put inside the plan, inside there. So put a good market study in. Why are we investing in these certain areas? Why Nashville? Why White House, Tennessee? Why Bowling Green? Why are these things important? It should be clearly outlined. Projected investment return metrics. Super important. A fund should not be buying something that returns a 10% average annualized return when the fund metrics are 25. Why are we buying this? It's going to drag things down. Outline the team and their experience is very important. All of this should be clearly outlined in your PPM. The biggest thing is diversification and risk management is why I love funds. It gives us the opportunity to truly diversify. Like I know a lot of you guys are investing in oil and gas. You're investing in Nvidia stock. You're investing in the S&P 500. You're investing in annuities. You're investing in bonds. That's your diversification. I get it. I understand it. Not trying to discourage you from it. Here's the cool part about a fund. A fund gives you the ability to diversify in the several real estate assets in one investment opportunity. How nice would it be that you could make one investment and that one investment would actually be diversified in the multiple asset classes that has different risk tolerances, different risk performances, different return metrics. So again, one property falters, the other stabilize. True wealth is built by removing the downside risk. I'm going to repeat that again. True wealth is built by removing the downside risk. So the defined difference here, guys, is a syndication, in my opinion, is transactional. Not a transactional guy, care less about the transaction. A fund is transformational. One multiplies effort, the other multiplies impact. Investing in alternative assets can be rocket fuel to your retirement account. I'm going to say it one more time. Investing in alternative assets can be rocket fuel to your retirement account. And I highly recommend that you invest through your retirement account. Way easier. Another great book, if you want to learn more about alternative assets, pick up Tony Robbins' book, The Holy Grail of Investing. Really goes into private equity, goes into other asset types. Most of the time, you can't get access to. It's one of the cool things about this is you have access to it as long as you're a accredited investor. So a life-changing opportunity starts with a solid foundation and communication. Here's some pro tips to take with you. If you got those two pens, hopefully the first one hasn't run out of ink. Invest with operators and fund managers that explain everything clearly. Take that to the bank. Make sure you understand the risk, the downside, and the upside, if there's any. Do your due diligence. Due diligence means do your research. Dig in, guys. Like, figure it out. Become a detective and figure out what you need to learn about what you're investing in. Ask this question. I've had a lot of people ask about track record over the years. Not to me, about others. I've never been one to put on my track record much online because I feel like it can be deceptive. I would rather somebody come to me and ask me, Eddie, what's your track record? Because I want to explain it. I want somebody to hear the conviction in my voice. I want to explain every nth detail of exactly what we do and how we do it. So rather than ask for a track record that can be emailed to you, ask this question. To what extent will you go if something goes wrong? Let me tell you the extent that I went when something went wrong. We had two assets in Dallas, Texas, North Dallas, Texas. I've done $170 million worth of real estate development, from utility grade solar to new buildings, new commercial assets, assisted living, bifurcated apartments, done student housing, done a lot of construction, 170 plus million dollars worth. Things go wrong because of that. I've always general contracted every asset we've ever bought and ever done construction on. I had a construction manager that was working for me, and I was running this construction remotely. I real quickly could see that things were going wrong. Things were not going as planned. And I know really quickly when you have an expiration date on an investment, you can't get it wrong. You can't spend more money per door on the renovations, and you definitely cannot go too slow. You are trying to meet your metrics, and you can't get this wrong. And if it does go wrong, you in the driver's seat better get in the car and go drive that asset back to the good places. So here's what I did. I told my wife, my wife and kids had never been away from me for more than 2 or 3 days at a time where they couldn't bring me lunch or come see me at the place I was doing business at. But for the first time ever, I had spent 2 weeks away from my family at a time because traveling back and forth Dallas was very time consuming and expensive. So I flew down there and found out all the things that was going on. I had to let go of my construction manager, and ultimately I moved into one of my apartment buildings, moved in there, And I started running both of these assets, hands on, getting things turned around. I was there for 6 months. 6 months. I moved away from my family, lived a separate life. I've been married to my wife for going on 13 years now, I believe. Um, yeah, I believe 13 years. It's went by in a breeze, so I don't really know the exact date or day or how much. Uh, but 6 months, and I flew home every 2 weeks to spend 2 days on the weekends with them and then fly right back. So what I would ask you is ask a sponsor. If something goes wrong, what extent will you go to? I can tell you, and my wife and children can tell you what extent dad would go to or husband would go to make sure an asset's right. Simply because those people invested with me, they trusted me, and it's up to me to steward their money well. And I'm going to do that. If it's in my wheelhouse to make sure I have experience to make something go right, I'm going to do it. I don't tell you that to brag. I tell you that because this is real, it's raw. And I believe that every operator that's raising capital from other people, they should really think about other people more than themselves. They should be the ones that go in and get in the trench. And closing statements, these are my favorite quotes here, guys. Do it once with excellence and let the impact multiply. My favorite statement, and the reason I did go to Texas, how you do anything is how you do everything. How you hold a door for somebody, how you jump on a call, how you subject yourself in public, how you do anything is how you do everything. How do you want to be remembered? By the guy that went to the greatest extent to do the right thing, or to the guy that just says, that's the risk of investing? It's your choice. Figure out who you want to invest with, but ask some questions. Anybody that wants to slide this exact pitch, you guys can scan this QR code. I'll leave it on the screen. And I know Matt probably has a couple questions that he wants to go over. Scan this, fill out a little bit of information, it'll email it to you, and you're welcome to have it and share it with others.
Awesome. That was great. Really, really appreciated that. And I really appreciated the story of you going and living in Dallas for 6 months. I know earlier in the presentation you were talking about the importance of communicating well. So I would have liked to have been a fly on the wall to see you communicate to your wife about your long-term
Yeah,
presence in Dallas.
yeah. Honestly, my wife knows who she married, and she knows that how we do anything is how we do everything, and she really fully supports that. And when I called her up and I said, "Hey, um, I'm gonna go get some stuff, and I'm gonna move into one of the apartments because it's gonna be longer than a hotel stay. I know that. I don't know how long it's gonna be. We had no idea it was gonna be 6 months, by the way. Honestly, I told her, I said, look, this could be a couple weeks, a month. I don't know. But all I know is I got a lot to do. And I started explaining it to her, and she's been beside me. She's the J in the JE Capital. Her name's Jennifer. So it's Jennifer and Eddie is JE Capital. And she's been beside me from the last 8, 10 years that we've ran this company side by side together. So she knew when that phone call came in that things were a mess. And she even said, I'm sure you're going to Dallas to figure out what's going on." I said, "Yep, I'm flying out tomorrow." And I get there and I tell her what all's going on. She goes, "You're not coming home for a minute." I said, "No, I'm going to go get some stuff. I'm gonna get an apartment here and I'm going to start figuring it out." And it was definitely painful, but I'm not going to say that it was beneficial for our relationship because it gave us real resilience and strength when we were away from each other. It only brought us closer together, but also it was something that needed to happen for me to actually see exactly what we were doing in a marketplace, in a community.
Awesome. Good. I'm glad it had a happy ending.
It did.
Two two questions. One's more of a comment and another's a question. So I'll go to the comment first. And this person said, kind of related to what you're talking about, uh, in asking the sponsor about how far they would go, etc. As far as I would go, I would file and document the risk. Real pros fix problems. Liabilities hide it, which leads to a lawsuit.
100%. Man, Please copy paste and email me that because I love that. And here's why I love this comment so well. We send out our investor communication to anybody that's invested with us every single quarter. We are we pride ourselves on this. Things go wrong, guys. They do. And we're not going to hide it from you. When somebody invests with us, we literally will tell you this, and this went wrong. This is the nuclear effect of it. But we're not going to just deliver that and that's just a close-ended door. We're going to deliver it with a countermeasure and what our next steps are. We never deliver bad news. We believe that bad news doesn't age well. It's like fruit. If it's rotten, just get rid of it. Communicate it and get it out of the way. But let's figure out what we're going to do to make sure it doesn't rot anymore. So you got to execute because the velocity of money is making fast decisions well. And to be honest, you can't stop yourself at not making a decision because you don't have it all figured out. Because the fruit's rotting. It's not going well. So communicate what's going on, come up with a proactive business plan, a countermeasure, communicate it to your investors. We've even had investors that had pretty good ideas on, hey man, I think I know what you're facing. I might know something that might help solve it. We're open to that. Because at the end of the day, we want a collective genius opportunity here. Not I know everything and I'm not going to take any advice.
Very good. This question this next one is a question. It's a great question because he articulated it a lot better than what I was going to ask. And the question is, I can see the advantages of a fund structure, diversification, faster capital deployment, etc. But what are the biggest downsides you've seen in practice, especially around blind pool risk, fee transparency, capital drag, and strategy drift compared with single asset syndications?
That is an unbelievable good question. And here's what I've seen. Operators that haven't done a good job of this, they have a very, very vague private placement memorandum or an offering memorandum, and there's no clear business plan inside of there. Here's what I mean. It is a blind pool, and it means the fund manager can deem this investment to be invested in any type of asset class, but that's not exactly true. Because if you put in that we invest in multifamily, townhomes, and businesses, then that's what you have to invest in. Like legally, responsibly, this is what the fund actually invests in. So you can't go buy a shopping center. You can't go buy an office opportunity. And if you do decide to do that, then it is supposed to happen to where you are revising that PPM and you're having the investor review the PPM again, and they have the opportunity to say, hey, I'm not comfortable with that. I don't want to invest in office space. I don't want to invest in storage units. Then you should, yeah, rightfully, you should return their money. So honestly, this comes down to that's why it's so important when I said a good PPM has to have those things because it's just as simple as this, guys. This right here, there has to be a solid market study. You have to know what asset type and you have to know the projections and you have to outline all these things well. Because if you don't, this is the scenario. So that's the only time I'll see a fund not work well is when it was way too vague and they had a bunch of investors come in and they just deployed it into all kinds of stuff just to get rid of it and not following their actual projections, their actual business plan.
So if you are, this is my own question, but it's related to that. If you're an investor and you're looking at a fund, and you know you have the very pretty pitch deck, but then you have the PPM, which is really the fuel behind the whole thing. Um, what are there sort of questions or part of the review process that you would recommend in terms of connecting the dots between the pitch deck and the PPM, like what to look for between the two?
Absolutely. Number one, are they consistent? Uh, Consistency is key. Like, okay, this is the pitch deck, but it doesn't match the PPM. You know, the pitch deck says that we're going to be, 30% average annualized returns. but yet in the PPM, it's like we're 20% average annualized returns. So start, comparing these differences between the two to figure out if there's any deception. And then you're saying we're investing in this medical deal, but yet it has no mention inside your PPM. Like it's your job, guys, to like really find what makes you discomfort, what gives you discomfort, and then start asking these questions. I love, love, love when an investor or potential investor sends a list of feedback. And I actually just did this exercise yesterday. Potential investor, she's never invested in a fund before. And she had like 8 solid questions, line by line by line. Like, what's the performance? How many assets are in the fund? It's a brand new fund. There's no assets yet. Okay, well, how long before my money's deployed? So I love those kinds of questions because number one, it gives us a capability to build a stronger relationship because I know that they are figuring out, I want to invest in this or I don't want to invest in this.
Perfect. And related to that, a lot of people are using AI to review PPMs now, and just to do their due diligence. What are your thoughts on that?
I don't think it's a good idea. Um, I really don't. I think that things can be missed. We know for a fact, and I mean for a fact, that most LLMs are or AI agents or any type of document that can digest or give you an answer on certain things. We've proven that you can actually manipulate an AI to
Hmm.
give you the wrong answer. So think about if the investor, not intentionally, but if the investor, the sponsor, purposely put in deceptive information inside the PPM, and the AI decides to read that and find the deception, and it decides to give you a deceptive answer, it's just following what it read.
Got it.
So I'm going to actually share. I think we got a few minutes. I'm going to
Yep.
share, and please continue with the questions.
One more comment from that same person who made the comment before was, um, I show the risks. So they're speaking from the perspective of being a sponsor. I show the risks first thing and then come up with the solutions, structural, legal, etc. Show the investor what they're getting into so things don't come up in the 11th hour.
Absolutely. Partnership agreements, operating agreements. Operating agreements are one of my favorite things to read and perfect, and here's why. A good operating agreement should have these things inside of it. Number one, what happens if things go wrong? How do we handle arguments? How do we handle breakups? What happens if we're in insolvency? What happens if money comes into the account? How is it handled? How is taxes handled? A good operating agreement is going to clearly outline that in black and white because black and white keeps friends. Because if I sent you, hey, if I sent you a friend contract, Matt, hey, this sounds ridiculous, but this is how we argue. This is how we get along. It's very clear. Okay, well, we're never going to put our feelings into this. We're going to put our facts into it because at the end of the day, it's clearly outlined. You agreed to it. I agreed to it. Hey, we got an issue. We got 10 days to send a formal letter on how we feel and how we're going to dissolve this problem. Um, I'm going to go to, yeah, so this is, essentially this right here is the introduction, and I'm not going to read it word for word, but this is like the exact how the fund operates. And you can see real quickly that the fund remains sharply focused on multifamily in Nashville, Tennessee, and the surrounding growth markets, and generally under 50 units. But we're using for urban infill, townhome projects, and subdivisions. But the first thing we do here is we go after cash flowing businesses. So as we go down through this, we have a return metrics, but this is our hybrid model. This is our investment strategy. This is our or integrated execution model. But right here, why are we choosing to invest in shovel-ready dirt?
And this is your fund that you're raising for right now.
Yep. So this is our PPM for this fund.
Okay.
This is 186 pages, by the
Wow.
way,
All right.
but we clearly outline everything.
Yep, and it's also done in a way that's uh fairly has a lot of flow to it. It's not just a bunch of text in a Word document. Like
No, no, we
it's made to be digestible.
right. It's made to at the front of it. Okay, this is the headline. This is the billboard. This is the J Capital Fund. This is the disclosures. And then, okay, well, here's kind of like the table of contents. And then we're going down through the legal structure of it. And then we're literally stepping through this. What's our guiding principles? What's our mission statement? What do we invest in? Why do we invest in it? Who's the management team? How do we make decisions? Like we even put in our operating agreement and our subscription agreement. So somebody, if they wanted to spend a week running through 186 pages, reading it word for word, it's all in there. Like every single thing is in there. So usually what I do is I will have my investors, potential investors, when they're going through our investor portal, we work with InvestNext. They will need to initial the PPM on the way down. Like
Hmm.
not every page, but at least you essentially went through it top to bottom.
Nice. So, we're nearly out of time. I guess the last question that I would ask you would be, you know, I'd love to hear how you became a private investment company, and especially like this mentality or this philosophy that you sort of like, you lean into the questions, you lean into the due diligence. Talk about, if you can, in maybe 2 minutes or less, what that story is like, and then we'll close things out.
Challenge accepted. I started as a welder at 12 years old. My dad wanted me to learn a skilled trade so I could go out and fend for myself and learn enough money to feed my family. Well, at 12 years old, I got to stand beside the men in big overalls, the men in blue jeans that I felt welded the world together at that time. And, they would get vulnerable at some times and talk about the retirement and stuff like that. And as I progressed throughout my journey of corporate America, I retired by age 36 from corporate America at 2016 to pursue this journey, to really go after it hardcore. And the reason I did it is because as I continue to manage people of all ages, especially older ones, it was very unfortunate that people would actually work their life away to retire and pass away because they worked so long. Because it seemed like the retirement accounts were broken. There was no way for them to grow in alternative assets to make way more money. I know that I invested in real estate and it did very well, but I took my business profits that I made from this and I invested and removed my taxes and I grew my wealth exponentially to where it gave the opportunity to me to retire by age 36 so I could go and enjoy life. Freedom is what you're chasing. You want enough money to go wherever you want, whenever you want, and take whoever want with you for as long as you want. So if that's what you're chasing, why do you need to wait till 70, 75 years old? So at my mind, in my opinion, there was no alternative assets for anybody to invest in. There was nothing out there. So as I learned, there is things out there, but I wanted to make sure I was at the forefront of doing the right thing to give somebody that investment opportunity.
Beautiful. Very well said. And you did it on time. So challenge achieved. All right. So we'll go ahead and close things out. Again, thank you, Eddie, for a great presentation. Really, really appreciated that. And thank you, everyone, for joining us and for the questions that were asked. You will get a recording of this in the next couple of days. And if you have any other questions that weren't answered today, please reach out to, you can just reach out to Camoplan, engage at camoplan.com. And Eddie, what's the best way to contact you?
You can go to eddieaustinbex.com. You can find me on all social media platforms, or you can email me at eddie at jecapital.inv.com.
I'm going to type that in, Eddie at jecapital.inv.com.
Correct.
Cool. All right. Beautiful. Great to have you. Any final closing comments from you, Eddie, before we sign off?
Be good, be great, and be extraordinary.
Well said. All right, everyone. You heard it from Eddie himself. Take that. finish the rest of the week strong. We'll see you next week on the next one. Thank you.